Hello everyone. Today in this session, we are going to start with a new concept that was added into the syllabus, which was there as a small theory in the previous course, in the previous syllabus of SFM, which was brought as a significant question and answers in the study material regarding area called as real options. So, first, before even we start with, this video will be exclusively from the exam's point of view as to if a question comes, how to approach towards the concept of real options. Let us try to understand. As the name suggests, real options. What do you mean by real options? Other than stock options. Other than stock options. Other than stock options means till now we have seen the call option, put option on the shares. Now we are going to see the call option, put option not on a share, but we are going to see on the real assets like land and building, plant and machinery, oil reserves, okay, intangible assets like patents, trademarks, brands, copyrights, etc. On that we are going to see the question. First listen before we start with this lecture. Before we start with real options concept, certain things I need to make very clear. In exam, a standard type of question will come. What do you mean by a standard type of question? There can be no great creativity in this. All questions will look alike. There are three types of models. One is a growth concept of options. Second one is, okay, first one is a growth concept of option. Second one will be a normal call option with two different notes. Third one is a abandonment option, which will be looked like a put option, which will be looked like a put option. So before we start with this, let us understand how the problem approach has to be and what is the concept. See here. Real options. First thing, I will first explain you with one example. Once the example is completed, we'll be going into the problem solving. Problem solving will be completed in no time. Those are not even so difficult. Just we need to understand the wavelength of this particular concept. Once you match to that, easily you can solve. This 1.5 hour lecture, if you properly follow and complete, examinations you are ever ready to solve any kind of question on the real options. Okay. Study material is having four questions or three questions. Okay. Study material will be having three questions. I am doing one extra question from the old RTP. Once upon a time also real options is there. One last time they have given one question on a RTP 2007 or 8 year. That question also we are going to solve. Okay. But since study material three questions are given already, I am expecting this RTP question only will come in exam, because everyone will at least mug up the concept or practice that. So people will not even know that there is a old RTP question on this now. That only they will ask. I will show you the RTP question first. I will solve that. I will explain what is the concept of real options using that. Okay. First, listen carefully. You are preparing for your AFM exams and you are writing for the May 24 exam. Please listen to this lecture till the end properly. Do the problems along with me. All the four problems, if you complete, birthday will be complete in 1.5 hour. Okay. If you practice on your own, it takes time. If you do along with me, it will be completed during the class itself. You will have a clarity in thought. Okay. Let's solve. First, let me explain the concept. There is a land. There is a land with the building. There is a land with building. There is a land. There is a land and building. Okay. Let's see. Which will have more value? Land will have lesser value than land and building because land has building also on that. Okay. If I constructed 100-floor building, okay, 100-floor building is there. For example, there is a land. On this land, I constructed a building. From this, what you have to understand, land cost is 5 crore. I constructed a 30-floor building on that. Each floor I sold at 1 crore. Means I am going to get 30 crores out of it or not. So, land is having more value or land with building will have more value. Obviously, land with building will have more value. Therefore, land tend to have a lesser value than land and building. This is a conventional way of thinking. But people say land has more value than land and building because land is a natural resource, land and building is a developed resource. Land is a natural resource, land and building is a developed resource. When I say developed resource, it's a past tense. Already happened. It was developed. There is no great creativity to do in that. Interiors you can do, but exterior you can't do anything. Already it is created asset. Yeah, you can't do anything with the created asset. Nothing is there for it to develop. It is a developed asset. But when it is a land, land will be a natural resource. Means it has a scope for doing so many things. When I say doing so many things, it has got options. It has got options. Okay. So point is, there is a situation like this. Okay. Today, after 1 year, today, after 1 year, first remember one point. In all the questions throughout the world, okay, in all CFA level questions also, CFA level 3, when I'm doing that, in that also, or even if you see the CA questions, there is one underlying assumption for all the real options. Assumption is you will be postponing the project. How many years you will postpone? They don't tell anything in the question. Even in the CA Institute questions, they don't tell postponement period. Assume it to be 1 year. Assume it to be 1 year. Okay. I will show you how the questions also have done. Assume it to be 1 year. See here. Point number one. 0, 1 year. 0 year means today. Today is 0 year, 1 year after. I have a land. If I construct the building on this land, if I construct building on this land, I can construct, say for example, 20 floors. Each floor ki one house I can construct. Okay. Each house will be having a sale price of 1 crore. Each having a sale price of 1 crore. 1 crore into 20 means 20 crore is my selling price. Okay. Next, cost. Each floor to construct, I will incur 30 lakhs for each flat. 30 lakhs into 20, I will be incurring 6 crores. I will be incurring 6 crores. Okay. Now tell me, how much is the sale price? Sale price is 20 crore. How much is the cost? Cost is 6 crore. What is the balance? 14 crore. This 14 crore will be land value of the land here. What is my land value of any asset? Present value of future cash flows discounted at required rate. Let us assume all are already discounted. Assume that these are all discounted figures. Question we will do discounting there. Assume that these are all discounted numbers. Now you will answer my question. Point number one. How much I incurred as a cost? 6 crore. How much I got as income? 20 crore. What is the value of this land? Benefit what we get is the value of a land. What is the benefit you are getting? I'm getting a net benefit of 14 crores. Now that 14 crores I will call as a value of the land. This is the option 1. No. I will wait till 1 year. I will wait till 1 year. I will see how the market is at that time. How the market is at that time. If the market is favorable by that time, I will decide to construct 30 floors. Okay. I will decide to construct 30 floor. Favorable means what? Market sale price is, say for example, 2.5 crore for each flat. Same 1 crore flat, if I can wait for 1 year, politics this particular elections time government is changing. Therefore, say for example, if the government changes, they will bring some changes in real estate as well. Prices are going to increase. This is the assumption. This is our expectation. Okay. When there is a chance to get 2.5 crore for each flat, which is 1 crore today, why can't I wait till 1 year? Like that also companies will think. Therefore, 30 flats at 2.5, 30 lakhs at 2.5. From this first, what we have to understand, I am going to get 20 crores. I am going to get more than 20 crores. I am going to get more than 20 crores. I am going to get more than 20 crores. Okay. See here now. First, I'm going to get 75 crores. I'm going to get 75 crores. What is the cost? Cost is, say for example, it will cost me same 30 lakhs for each flat. I have to spend 9 crores now. Now my net benefit is increased or not? So this is the situation. If market is favorable, then this is the situation. Market also can go adverse at that time. Price can go up to 0.75 lakhs, 0.75 crores only. At that time also I will do. There is a probability of occurrence of this 2.5. There is some probability also for occurrence of 0.75. Both put together we will take risk neutral probabilities and do as per the derivative option models. Okay. So therefore try to understand. We are having two options. Option 1, go with the existing scenario, or postpone your decision, go for 1 year, and at 1 year end, expect the market to be either better or bad. Better now, what will be your payoff? Worst now, what will your payoff? Calculate, use the probability, apply the probability on these values, and then you calculate the value of a land. This is the second model that we have to do here. Now we are going to do in this chapter like this. Clear? So therefore, what we are going to do? We are going to value the assets. We are going to value the asset, not as an asset, but as an option. Not as an asset, but as an option. Land we are not going to value as an asset. We are going to value the land as an option. Land as an option. If land is there, I may construct 18-floor building. I can construct 30-floor building. I may also keep it vacant. Options are available. When you construct a building, option is not available here. It was already developed resource. There is no option. You have to either sell or give it for rent. Understood the point clearly or not? With this intent, this particular chapter has started. Shall we do the problems? No. Read the notes once. In this concept, we are going to learn how to value the assets, natural resources using the option valuation models. Understanding the accounting balance sheet itself is a challenge. Then understanding fair value of the balance sheet items is a much more difficult task. We are going to value the fair value balance sheet. We use fair value using option valuation models and not by the traditional methods. Valuation of a vacant land. RTP questions are very, 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 very important. If my expectation come right, direct question like this with a change in numbers will come for 8 to 10 marks. Let us see. A builder owns a plot of land that can be used either for 30, 18 or 30 apartment building. The construction cost for these alternatives are rupees 18 million, 34 million. I will write it as, okay, 80 million 180 lakhs, 34 340 lakhs. Price per apartment currently is 1.2 million, means 12 lakh. Yearly rental per unit rent 1 lakh. 0.0 million, 10 million means 1 lakh. Risk free rate 9% per annum, RF. If the market for the apartments is buoyant, buoyant means it is favorable. Next year, each apartment will fetch rupees 150 lakhs. If it is sluggish, it will come to 110 lakhs. What is the value of the vacant land? Assume that construction cost will remain unchanged. Use risk neutral method. This is a question that is being asked. 2 minutes time I will give. Okay. First read the question. Once you read the question, we'll be going into analysis. Read the question. The question. Please read only the question. Question. Let us read one last time. A builder owns a plot of land that can be used either 80 or 30 apartment building. The construction cost for these alternatives are 18 million, 34 million respectively. Price per apartment currently is 1.2 million. Yearly rental 0.1 million. Risk-free rate 9% per annum. If the market for the apartment is buoyant next year, okay, buoyant next year, buoyant next year, it will fetch 1.5 million. Sluggish, it will fetch 1.1 million. Calculate the value of a vacant land. First, listen. He is asking us to calculate using risk neutral model. First, listen. Traditional method, like any capital budgeting problem, if you do this, like a capital budgeting problem, if you do this, see, what is the cost of asset to construct this? To construct this, I will be incurring 18 million to construct this, 34 million to construct the 30 floor, 18 floor, 30 floor, or 30 apartments, anything. 18 apartments, 13 apartments, 30 apartments. 18 apartments, 180 lakhs. 30 apartments, 340 lakhs. 30 apartments, 340 lakhs. What is this? This is a cost of construction, number one. Number two, what can be the sale price after 1 year? What can be the sale price after 1 year? How much I can sell? I can sell at 150 million if the market is good. I can sell at 110 million if the market is bad. That's the idea behind this. Okay. Now, but if you are valuing it as an asset but not as an option, how to do? If you treat the land as an asset, if you treat land as an asset, means you will construct it today itself. You will construct today itself. If you construct it today, price of each apartment is how much? 1.2 million. You can sell at that. Okay. See here. NPV. Let's see. What is the, sorry, 18 apartments, 30 apartments. 18 apartments cost will be 18 into, okay, cost will be 180 lakhs. 180 lakhs. Here cost will be 340 lakhs. Sale price will be, at what price I can sell? I can sell at 12 into 18 lakhs. Sorry, 12 lakhs into 18. 216 lakhs. Next, 360 lakh. Final answer. NPV of decision will be, the first case, 216 minus 180, 36 lakh. 340 minus, 340, 20 lakhs. What is this? 36 lakh. What is this? 20 lakh. This is the value of the land. Value of the land. What do you mean value of the land? Whatever the benefits you are going to get from some asset, net benefit, we call it as a value of an asset. What is the value of any asset? Present value of future cash flows discounted at required rate. Present value of future cash flows discounted at required rate. What will be the present value of future cash flows? Future cash flows will be getting present value 216 lakhs. Okay, discounted at required rate of return. Already discounted, we are assuming that 216 lakhs. What is the cost of this particular asset? 180. What is the net benefit you are getting? 36. Therefore, the 36 we call it as a value of a land. That means a land which is worth 36 lakh, if you have, you can construct apartments, 18 apartments. Okay, that's the point. Now listen carefully to the point. See here. Next issue. Second. Next one, you are getting 20. Tell me, if today you do the sale, 18 apartments sale will give you 216 lakhs at a cost of 180, you are getting a net benefit of 36 lakh. Here, if you sell today itself 30 apartments, you have to incur a cost of 340, sell at 360, you are getting 20. You will construct today 18 apartments, 30 apartments. 18 but not 30, decision is taken. If you treat the land as a asset, if you treat land as an asset but not as an option, value of the land will be 36 lakh. The benefit what we get from an asset is the value of that asset. What is the benefit you are getting? 36 lakhs is the benefit I am getting because of having this land. Therefore 36 lakhs is the value of the land. One point completed. Next, option number 2. Land is not an asset, but land is treated as a option. If I have land with me, okay, instead of starting anything today, I will wait for 1 year. If I wait for 1 year, I will have two options. Option 1, I can construct 18 apartments. I can construct 30 apartments. Number 1. If I have a land today and I am not doing anything today, I am waiting for 1 year. Market can be buoyant, market can be sluggish. Market can be buoyant, 18 apartments, 30 apartments. Market is sluggish, 18 apartments, 30 apartments. I can construct in any way. Let us now calculate the payoff. Let us now calculate the payoff. Payoff means like NPV type. Net how much we will be getting after 1 year. Let us check the situations now. Okay. See here. After 1 year, market can be buoyant. Market can be sluggish. Market can be buoyant. Market can be sluggish. If market is buoyant and I am planning to construct 18 apartments, I am planning to construct 18 apartments. Tell me, what is the cost of constructing 18 apartments? My cost of constructing 18 apartments will be 180 lakhs. Sir, 180 lakhs today. That's why in the question they have clearly given, assume that construction cost will remain unchanged. That's all. Answer over. So, 180 lakhs. And next one, 18 apartments, sluggish also, 180 lakhs. Sale price. If market is buoyant, I can sell each flat at 12. What is that value? I can sell it at 15 million. I can sell it at 15 million. Each apartment will fetch 15 million. 15, 1.5 million. 1.5 million means 15 lakhs. 15 lakhs into 8. I can sell at 270 lakhs. If market is sluggish, I can sell at 11 lakh. 198 lakh. 198 lakh. Tell me, what is my payoff? 270 minus 180, I will get 90 lakhs. 198 cost is 18 lakhs. This is my payoff if the market is buoyant, if the market is sluggish. If the market is buoyant, what will happen? 90 lakhs will be my value. If the market is sluggish, what is my value? 18 lakhs is my value. Next, market, I am not constructing 18, I am constructing 30 apartments. Okay, same concept. Market is buoyant, market is sluggish. Cost, sale price, payoff. Let's see. Cost. I have to incur a cost of how much? If I construct 30 apartments, 340 lakhs I need to spend. Sale price will be 15 into 30, 450 lakhs. 450 minus 340. Payoff will be 110 lakhs. 110 lakhs. Okay. And market is sluggish. Then what will happen? 11 into 30, 330 lakhs. I am getting a value as minus 10 lakhs. This is my payoff. If the market is buoyant, now observe a situation. After 1 year, now I am not constructing the house, I mean the building today. I postponed my construction by 1 year. 1 year completed. After 1 year, really market became buoyant. I will get really market became buoyant. If I have 18 apartments, I will have 90 lakh rupees as a benefit. If I have 30 apartments, I will have the value as 110 lakh. From this, what you have to understand, since I don't construct it, I have an option to construct after 1 year. When I have an option to get 110 lakhs, why I will have 90 lakhs? Yeah. Therefore, after 1 year, if the market is buoyant, I will choose to have 30 apartments. This is the answer number one. Number two, let us say market became sluggish after 1 year. Let us say market became sluggish after 1 year. If the really my market became sluggish after 1 year, I will choose to construct 18 apartments, or I will choose to construct 30 apartments. If I construct 30 apartments, I have a negative flow. If I construct 18 apartments, I will have 18 lakhs. I will choose minus 10 lakhs. I will choose 18 lakhs. I will choose 18 lakhs. In no situation I will get a loss because I have an option to construct. Yeah. So therefore, I will not go for this. I will not go for this. I will go for these two after 1 year. If the market is buoyant, bumper offer 110. If the market is sluggish, I will at least get 18 lakhs. Are you understanding the point or not? But market will be buoyant or sluggish after 1 year. We don't know. There is a probability for that. How to calculate probability? Risk neutral probability we are going to use now. To the point or not? Because 110 is the answer, 18 is the answer. 110 is not the answer, 18 is not the answer. It's a probable. Okay. What is the probability of getting buoyant situation? What is the probability of getting a sluggish situation? Using risk neutral model, we are going to calculate the probabilities. Then we will apply the probabilities on the numbers. We will get an average value. That will be the value of the land. The point or not? Let's do. Okay. Now, this is up to here. Hope everyone understood. So this one is easy. Normal traditional method like you do like this. Okay. Traditional method you are going to decision today. You are going to decide today. Therefore, that 340 or market sluggish will not affect you. Okay. So second, you are not going to construct today. You are going to wait for future and see how the situations will be in the future. Therefore, market can be buoyant, market can be sluggish. Okay. So these are the payoffs. So one thing is clear here. This situation we are not going to consider while valuing. We will consider either this or this. If the market is buoyant, I will get 180. If the market is sluggish, I will get 18. I will give you one example. Use which model? Risk neutral model. Risk neutral model. Risk neutral model, what is the step number one? Calculation of risk neutral probabilities. How to calculate risk neutral probability? A first situation AP, value of the land, probability, probable value. Market is buoyant, market is sluggish. If market is buoyant, each one can be sold at 150. That's sorry, 15 lakhs. If market is sluggish, each one can be sold at 11. If I can sell at 15, what is my net value of the land? Okay, net value of the land. What is the land value of a land? Benefit what I derive out of it is a value of the land. How much benefit I can derive? If it is 15 lakhs, I will go for 110 lakhs. 110 lakhs. If it is sluggish, I will go for 18 lakh situation. What is the probability? That's what we wanted to calculate. Okay. First listen carefully. Risk neutral probability we have to calculate. What we have to calculate? Risk neutral probability. So what we do is we need to get the value of a risk neutral probability to be put in this particular table. So we need to first calculate the risk neutralized probabilities. Okay. Now, first point number one, we have to calculate risk neutralized probabilities. Understood up to here, but every student, please listen carefully to this point. Tell me, if I have a share, I have a share, if I have a call option to buy a share, who will get the dividend? Person having a share will get the dividend. Person having the option to buy a share will get dividend. Repetition. I have a share. I have a call option to buy a share. Who will get the dividend if the company declares a dividend? Person having a share will receive dividend. Person having a option to buy a share will not receive the dividend. Therefore, what we will do, whenever we do value of a call equal to spot price minus present value of strike price. Whenever you take this spot, okay, first listen carefully. Spot and strike price. Strike price will be there today, na? In future, in future, strike price will come. Today, what will be there? Today, spot price will be there. Okay. When you are comparing strike price with that of a spot price, strike price is what which occurs in future, dividend will come if you have a share, if you have an option to buy a share. If you have a share, means spot, if you hold the share, dividend will come. If you don't hold the share at spot, you won't get the dividend. I repeat, if you hold a share at spot, you will get dividend. If you don't hold the share at spot, you won't get the dividend. So SP don't get the dividend. SP don't get the dividend. SP is a ex dividend share price. Spot is a cum dividend share price, because if company declare a dividend, spot who bought the share will have a dividend. Who will have an option to buy a share in future will not get the dividend, because by the time you exercise and buy, mela over, dividend is not there. So SP is a ex dividend share. Spot is a cum dividend share. A cum dividend share can't be used to deduct from an ex dividend share. Yeah? When you compare correct way. Therefore, whenever you calculate with the dividends, you will do spot price minus present value of dividend or present value of income. Various authors, various faculties, various books will use various notations, but concept is same. We will calculate the present value of dividend, or we will calculate the present value of income. People may call like that. Same happens here. Tell me, if I hold the land and building today itself without waiting for 1 year, I would have received 1 lakh rent per annum. I would have received 1 lakh rent per annum, because 0.1 million rent will be coming or not. Who will get the rent? Rent will come to the person who have the building, not to the person who have the land. Okay. So whenever you calculate the spot price should be calculated deducting the rent from that. Okay. Rent means rent directly. Present value of rent. Present value of rent. Okay. See here. How to do rent. 1 lakh. This 1 lakh rent is a rent you will get after 1 year. After 1 year, you will calculate a present value for that. Divided by what is the discount rate given? 9%. 1.09. 1.09. 0.917. 0.917. Okay, 0.917. So spot equal to, okay, spot price minus present value of dividend, present value of rent. Okay, spot, how much? 12 minus 0.917. 11.083. 11.083. What is 11.083? This is the revised spot value of the land, revised spot value of the particular building. Okay, technically you will get a rent. Na? See here, read the question. The price per apartment 12 million. That is okay. Yearly rental per unit. That means if you have a building today, 1 year after you are going to get a rent of 1.1 million. When you will get 1 year after, you will get the rent. But if you postpone to 1 year, 1 year after construction will start. So you will not get a rent. So that 1 year rent you will not get if you enter into a option but not having a building today itself. Therefore, you are comparing with that particular values. Na, you have to bring the spot also to without rent. So X rent, cum rent type. Okay. So cum rent value is how much? 11.083. Okay. We don't know the probability. P 1 minus P. Always higher price P, lower price 1 minus P. Risk neutral model. We are not here to discuss about that now. So tell me, 110p, 18 minus 18p, total, total, 18 plus 92p. Okay, next. So we calculated probability. This is one way of doing it. There are two ways. This is one way. Or ICA follows this model. ICA will follow this model. Which model? See here. Situation, AP, probability, value into probability. Directly 15 and 11 they will take directly because they will compare directly with the 11.083. Situation, buoyant, sluggish. Actual price will be 15, 11. This is same. I will call it P, I will call it 1 minus P. Okay. Next, what is the value into probability? 15P, 11 minus 11P. Numbers will change, that's all. Anyway, for 11, for 15, corresponding number is 110 only. Okay. Instead of taking that, they will take like this. So tell me, how much is the answer? 11. Okay. 11 plus 4P. 11 plus 4P. Okay. What is this 11 plus 4P? 11 plus 4P is the value after 1 year. This is the value after 1 year if the market is buoyant. If it is the value after 1 year if it is sluggish. Therefore, this is the probable value of both put together. How much? 11 plus 4P after 1 year. Okay. What is this value? This is the spot. This is the spot. Okay. This is 1 year after. This is spot. We will take this to future now. Spot will be taken to future. Future value of spot equal to means 1 year value we are going to calculate, that equal to 11.083 into what is the compounding factor given in the question? 1.09. 11.083 to 1.09 is 12.08. 12.08. First tell me, sir, why you multiplied like this? Reason. Sir, options law I told you very clearly. Normal derivative options law. Risk neutral concept law, what is the model? What we will do in the risk neutral model is, we will first calculate a probable value. That will be the value after 1 year. They will give a spot price. Okay, they will give a spot price. Spot compounded to future using a risk-free rate will become the value in future. Say for example, a person invested in a share worth 100. Okay, he expects a risk-free return of 3%. Risk-free return of 3%. A person invested in a share today at 100. At 100. A person invested in a share today at 100. He want a risk-free return of 3%. Risk-free return of 3% after 1 year. His price should be how much after 1 year in order to get a 3% return? How much should be the share price after 1 year to get the 3% return? Obviously 103. If I get 103 price, 103 minus 100 divided by 100, I will get 3% return. That means a person who invested 100 at spot should get a future value of 103 to get the return of 3%. Clear? This also will be the same. What is 11 plus 4P? This is the price after 1 year. Price after 1 year. What is the price of the building today? 11.083. I want a return of how much? 1.09. This 100, 11.083 same. This 3%, this 1.09 same. Therefore, what will be the 103 value here? 11.083 into 1.09. What is this? 12.08. What is this 12.08? Value after 1 year. What is this 11 plus 4P? Value after 1 year. Equate both of them. You will get the value of P. So 11 plus 4P equal to 12.08. 4P equal to 12.08 minus 11. 1.08. P equal to 1.08 divided by 4. 0.27. 0.27. 1 minus P equal to 0.73. 0.73. What we calculated now? Risk neutralized probabilities. In this, what is the new point we learned? All the remaining are like risk neutral model, what you do in the options chapter. The only new concept is whenever rent is given in the question, don't forget, my dear students, rent given, that rent will come only to the person who is having the asset like building, but we are comparing with 1 year situation where land day will be there after 1 year. So with the ex rent price you can't compare a cum rent value, therefore you will bring it into ex rent value spot as well. Okay, that's what we have done. How much is the probability? 0.27, 0.73. Okay, see here. Or sir, this rent, you have rent, you reduce it from the spot na sir? No sir, I will not reduce from the spot, I will add to the future. Then also answer will be same, same answer will come. See here. Or risk neutral probabilities, alternative 2. See here. What is the price today? 12. That can become how much? 15, or that can become 11. First, what we have done, we reduced it from 12. Now I don't reduce from 12. After 1 year, directly I will add to 15 and 11. 1 lakh becomes 16. 1 lakh become 12 lakh. Will the answer be same? Let's check. AP, probability, AP into probability. 16 lakh, 12 lakh. P, 1 minus P. 16P, 12 minus 12P. Okay, 12 plus 4P. 12 plus 4P. 12 plus 4P equal to 12 into 1.09. 12 plus 4P equal to 13.08. 4P equal to 1.08 equal to 0.27. Even in that case, you will get the same answer. 1 minus P equal to 0.73. This is how you can do. Either you adjust to the present trend or you add to the future. But really, if you think, rather than adding to the future, deducting from present correct. Even in the options chapter, we will do the same. Na? Why I have done in the alternative 2, shall I tell you? Our ICA is very, very popular for maintaining inconsistency. In one question, he will do in one way. In another problem, he will do in another way. Actually, in the RTP, they have done in this way. I don't know why they do like this, but actually there should be some consistency. Yeah. So present value lunch you should reduce. Sir, okay. Anyway, institute has done. Okay. Raji anukunte debbalik kodava. So therefore, we can't do anything. It's a systematic risk coming from the ICA directly. I can't do anything. You can't do anything. Just to follow them. Okay. So 16 lakh and 12 lakh. But my intention is to show you both the alternatives. Okay. So therefore, institute is not following this model at all. Therefore, I am directly teaching with the how institute is following. So AP means per apartment value you take, not the total value. Okay, per apartment you take, you will get 11 plus 4P. Compare it with this spot. If there is a rent, reduce the rent and calculate and do. Or you can either adjust like this and you can do. Any way you can do. Both are correct only from the institute point of view, but as per CFA and worldwide procedures, what the people follow, they will adjust only to the spot. Next, completed up to here. Last step, value of the land as an option. Situation, AP, value of land, probability, value into probability. Now you will get a clarity. Situation, market is buoyant, market is sluggish. If the market is buoyant, actual price will be 15 or else 11. If it is 15, I will get 110 lakh. If it is sluggish, I will get 18 lakhs. Now there is a probability for this higher 15, 0.27. For this lower 11, 0.73. 110 into, overall 110 I will get. 110 into 0.27, 29.7. 18 into 0.73, 13.14. What is the value of the land after 1 year? 13.14 plus 29.7. How much? 42.84. This is the value today na, after 1 year, after 1 year. Therefore, this is also after 1 year. But we have to take a decision today na. So what is the value of the land today? 42.84 divided by 1.09 will be 39.30. Tell me, what is the value of the land if you treat it as a option 39.3? What is the value of the land if you treat it as an asset 36 lakh? See, values are increased if you treat it as an option rather than treating it as a asset. Treating it as a asset. But one thing, my dear students, everyone should understand one thing. Here, land is an option. Here, land is a option. Do you know how to understand this? See here. Value of a call equal to spot price minus present value of strike price. Spot price minus present value of strike price. Meaning what? I will first tell about the stock options, later come to the real options. How to understand this formula? A call holder, everyone, a call holder will short sell at spot. Short sell at spot. Short selling means what? Borrow the share from some person, sell it. Means you have an obligation to give it back in future. At what price you will buy? You will buy at strike price and you will sell it. And you will return it back. So tell me, spot law what you will do? Spot law you will do sale. Okay. And future law what you will do? Buy and return back the share. Same concept will come. Even in case of real options, whenever question is given on taking up some option, taking up some decision, first to keep it in mind. Question if there is a sale value given, that is always a spot price. Question any cost is given, that is always a strike price. That is always a strike price. In the given question, strike prices are 340 lakhs and 180 lakhs. Cost is there, na? Those are all strike prices given in the question. Okay, spot prices are there, na? 12 lakhs is given, na? The 12 lakhs is a spot price that we have considered. Okay, next one. Sir, where is the option premium? Value of land a option premium. Land is an option here. Means what? You have to pay a premium of 39 lakh 30,000 or 39.3 million or 3 lakhs or something. 39.3 lakhs, if you pay as a premium for the land, you can exercise an option whether to construct 18 or whether to construct 30. That's how you should understand these particular questions. Okay. So therefore, always in these questions, whenever real options has to be treated as a call option, what you have to do? Any sale given, sale value given, that should be treated as a spot. Any cost given, that should be treated as an SP. That should be treated as a SP. Are you understanding the point or not? This is how the value of the land will be made. See here. I have given the answer clearly. First, I'm brushing through the concept once. Construction cost 80, 30. Selling price 12. Selling price, that's why we treated it as a spot price. Okay. Next, future 15, 11. Rent 1 lakh. Interest 9%. Term 1 year. Like this, you have to write the exam question whenever given. Format. First, if you treat it as an asset, 20, 36. When there is a chance of 36, why you will go for 20? You will go for 18 apartments. When you treat land as an option, let us see the payoff. If the market is buoyant, 18 apartments give me 90 lakhs, 30 apartments give me 110, 18, 30, 30 lakhs. When there is a chance of 110, why you will go for 90? 90 strike. When the market is sluggish, when there is 18, why I will go for 10? I will strike it. That means after striking, what will happen? If the market is buoyant, I will go for 30 apartment. If the market is sluggish, I will go for 18 apartment. Now I have an option. That means land, you are treating it as an option. 340 is the cost, 450 is the income. Net land value is 110. Because of this land, you are constructing at 340, selling at 450. Net land value is 110. Value of the land is nothing but the net benefit you are getting out of the building sale. Okay. Next, risk neutral probability. These all you have seen. You can calculate in two ways. 1.09. I also done using exponential compounding, discounting and normal discounting. You should follow normal discounting. Go by this. 15, and they are taking only individual values, and I have also taken individual values. CFL a different way they will do, but Institute has done it in a different way. I'm going the point. 42 present. See here. A natural resource sometimes has a better value than a developed resource. In the above problem, a land with an 18 apartment building has a value of 36 lakh today, but the value of land alone is 39.30 lakhs. This can be interpreted as follows. The land with 18 apartments has a restricted use because the land is developed for a particular purpose called as 18 apartments building. However, An undeveloped land is an option on which we have multiple uses and we can exercise option to develop for that, which is more beneficial. In this case, if the land is kept vacant for 1 year and if AP of the apartment is 15 lakhs, then we can construct 30 apartments where the value is 110. If the market is sluggish, then the apartment price falls to 11 lakh. We can get 18 apartments exercise and value is 18 lakh. This choice is not available if the land with 18 apartments is constructed today. Thus, land is not an asset, but it is an option. Price paid for the land is not a cost of asset, but it is an option premium. Construction of building on the land is excising an option. Construction cost is like a strike price. That's why construction cost is like a strike price. Any outflow will be the strike price. Any inflow will be the selling price, which is the spot. Apartment selling price today is the spot and the price after 1 year is AP. Is the spot price and AP comparable? No, because spot price is having rent inside. These don't have rent. Two types you can do. Either bring 12 lakh to present or take 15 lakhs with rent. It is not comparable because 12 lakh spot price is cum rent and APs are ex rent. It is similar to underlying asset giving a dividend in the option period. In such case, we should calculate revised spot price and convert spot into ex rent. Alternatively, it can be presented otherwise around. Instead of converting spot into ex rent, it can convert AP into cum rent. This is how it does not affect the final answer. Conclusion: vacant land is not an asset but an option. This much explanation I have given you, you cannot find anywhere in the study material or anywhere in these channels. Please listen carefully. I have done lot of research to make you understand how this options concept really works. Okay. With this, we completed a primary question on the real options. We will now do the ISM questions. This is RTP question. Now ISM 3 questions are there na? Just like that we can do and solve and complete it. Okay. Shall we go with that? Now, so I will do one thing. This video first I will upload such that you will get a clarity as to what is a real option. 3 problems na hardly 15 minutes. Another 35-40 minutes I will complete of all the remaining concepts as well. Okay.